Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Nokia stock by analyzing their financial statements and dissecting their financial ratios, so we can determine if it's a buy or a sell. Nokia is a telecommunications, information technology, and consumer electronics company, founded in 1865. Its headquarters are in Finland. Let's get started with the model. This is a large cap company, 36 billion market cap. They're trading at $6.55 a share, and they have 5.6 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company had a lot of free cash flow in the trailing 12 months, $2.3 billion, but they had negative in 2019 and 2018. Net income is the profit and loss on the income statement. It's revenue minus expenses. They also had a nice positive in the trailing 12 months, negative in 2017 and 18. Revenue is the sales for the company. That seems to be declining a little bit. It was $28 billion in 2017, down to $26.9 billion. This is the company's income statement. All these numbers are in euros, but my Excel spreadsheet converts everything to US dollars. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Then below that is gross profit. And that was pretty steady in the past 3 years. It did peak in 2017 at 9.1 billion. Below that is operating expenses. And they did a good job at managing their expenses. They had really low operating expenses in the trailing 12 months, giving them their highest operating income, 1.7 billion euros. Below that is the interest they pay in their debt. Then below that is other income and expenses. These are usually impairments in this field. Below that is pre-tax income, then taxes. So the bottom line of the income statement is their net income, and that was high in the trailing 12 months, 700 million euros. They did have a big negative in 2017 because of the negative 800 million in other income and expenses. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And they did have a lot of free cash flow in the trailing 12 months, negative in 2019 and 18. And the company did issue a lot of debt in the trailing 12 months, 1.6 billion euros. They did pay down €500 million. And before that, they didn't really issue much more debt than they paid off. The most important part of any business is their operating cash flow. And this company did generate a lot of operating cash flow in the trailing 12 months. Not so much in 2019 and 18. They did have a good amount in 2017 at 1.8 billion euros. And the way you calculate operating cash flow, you start with net income, that was 700 million. Then you have to add back the depreciation, that was 1.3 billion. Depreciation is a non-cash item that gets passed through as an expense on the income statement, so it brings down your net income. They also had 378 million of deferred taxes, $500 million of other, and a 39 million euro asset impairment. So even though they reported $700 million of profit, they actually generated 2.5 billion of cash flow. The reason they had such low operating cash flow in 2018 and 2019 was mainly because of changes in working capital. In 2018, it was negative 900 million. In 2019, it was negative 1.8 billion. Changes in working capital are changes in accounts payable, accounts receivable, inventory, things like that. Let's look at a capital structure. $18 billion of equity, $6 billion of debt. So they're 3/4 equity, 1/4 debt. But they could pay off all the debt with the cash on their balance sheet and still have $1 billion of cash left over. Their WACC is 6%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's 79 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $71 billion. We divide that by 5.6 billion shares. And we get a calculated stock price of $13. They're trading at $6.55, so they're trading at a 49% discount. It's a buy according to the model. Simply Wall Street is in the other direction. They're valuing the stock at $4, so they're saying it's overvalued. They're saying it's a sell. Nokia stock has gone up a lot the past few days because people on the Reddit message boards have been really pumping up this stock. The stock has been pretty steady for the past few years. It did come down a lot at one point, but it's come all the way back up in recent days. This stock has a beta of 0.54, so the stock moves half what the market moves. And the stock has gone up 21% in the past 52 weeks, which is better than the S&P 500 of 17.6%. The low was $234, the high was $9. The stock is trading above its 50-day and 200-day moving average. And this is a very liquid stock. Over 130 million shares have been traded each day for the past 10 days. And of the 5.6 billion shares outstanding, 4.7 billion are on float. Only 5% are held by institutions, and it has a really low short percentage, under 1%. If you invested $10,000 into this company 10 years ago, you'd have about $9,000 today. BlackRock is the biggest shareholder at 5.5%. Then Solidium at 5%, Vanguard, then two more companies below Vanguard. Let's look at the financial ratios. The average PE in the market's 11.2, the median is 14.3. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have a 41 PE, so investors are paying $41 for $1 of earnings. Price to sales is stock price over sales per share. They're at 1.4. That's better than the median and average. Price to book is stock price over book value per share. That's 2.0, also better than the median and average. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet. And they have 18 billion of equity, 7.4 billion of tangible equity, because they have 5.5 billion euros of goodwill and 2.4 billion of other intangibles. Interest coverage ratio is EBIT over interest expense. They're 8.6, so they can easily cover their interest payments. ROE is net income over equity. They're at 5%. They have a low ROE. Current ratio is current assets over current liabilities. They're at 1.4. They have a good current ratio. And the current assets are 6.2 billion of cash, 6.8 billion of receivables, and 2.9 billion of inventory. So it does seem like the company is well capitalized. They did have positive free cash flow, and they have 5.8 billion of working capital. The best way to look at ratios to compare them to similar companies, I've done videos on Ciena, Ceragon, Cisco, Ericsson, Hewlett-Packard, Motorola, all in the same industry as Nokia. And if Nokia has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in PE. They have a really high PE ratio. They are doing better in price to sales and price to book. They have a good current ratio. They do have a positive ROE. The average is negative. They're lower in debt. They are a little smaller than the average company in the industry. So to summarize, I do have them trading at a 49% discount. I ranked their free cash flow 7 out of 10 because they had a really good number in the trailing 12 months. I ranked their revenue 6 out of 10 because it hasn't been improving much. And I ranked their ratio 7 out of 10. So Nokia is a pretty well-known company, so I don't think they're going anywhere. The other stocks that are getting pumped up, like GameStop, are not such a good company. They're definitely struggling. This company isn't really struggling, so I think it has a decent future. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on a link in the description below. Thanks for watching.